Hello and welcome to Large Purchases. We're going to be talking about mortgages because it's the largest purchase you'll likely make in your life, but really it's just about how loans in general work. So we did some of this in Finance Basics, and a lot of what we're going to apply to houses applies to cars, boats, or other large purchases. So a lot of it's applicable many different places. So we'll talk about how financing works, the impact of good credit, how it ties to taxes that we just covered. We're going to cover a lot of that. There's also some stuff we're not going to cover, like how do you choose a house and how do inspections work and all of those kind of contingencies, which is important, but I want to focus more on the economics of how do these things tie together and incentives drive behavior. We're going to be talking about buying a house, but let's be blunt right up front. Buying a house isn't the right decision for everyone. If you're not planning on living in a place for more than a couple of years, it's certainly not the right decision. If you absolutely hate doing upkeep and maintenance, it's not the right decision. If it's going to financially strap you, it's not the right decision. Even though we're jumping right into home purchasing, know that home purchasing isn't right for everyone. If you are going to purchase a home, there'll be complex analysis later on where you can qualify for purchasing a home. But there's some general guidelines. So you don't want to spend more than 25 to 30% of your take-home pay in housing or 2.5 times your gross annual income. Otherwise, what's going to happen is you're going to be considered house poor. So again, renting versus buying, it's not always obvious that you should buy. There are times you should certainly rent. So if your lifestyle doesn't allow you to be a homeowner, that's just fine. If you are going to be traveling a lot and mobility, renting is also a lot more stable in the short run. So if something major goes wrong, you don't have to pay for it. It's the landlord that will have to fix whatever breaks, a door, a roof, whatever. But in the long run, being a homeowner does have some financial benefits. Some of them include that housing prices can appreciate. So if you buy a house for $100,000 and then 20 years later it's worth $200,000, you can make some money on that. Although it should be noted, and especially right now, I'm starting to feel like housing is in a bubble, which means that if housing prices are high, they could go down. You could buy at $100,000 and it only be worth $50,000. There's risk to buying. But if you do decide that you're going to buy, you're going to have to do some basics. You're going to have to figure out what kind of house you're looking for and where and all that other fun stuff. That's step one, determine a house. It's worth noting that in economics, we have something called compensating differential. And a compensating differential is if you take two things that are exactly the same, as you make one of them slightly more attractive, you have to pay for it. So if you take two houses that are exactly the same, and then you make one in a better location, it's worth more. If you take two houses that are exactly the same and one has better schools, you're going to have to pay more. If you have one has more room or more bathrooms or whatever, you're going to have to pay for that. So it's worth noting that the number one thing that people look for when buying homes is that the homes are in a good school district. It is the highest predictor of resale value. So even if you don't have kids, it's often worth considering where you're buying because it's going to influence the demand for that product later on. Now, if a lot of what I'm saying sounds complex or like it's real estate, then yeah, get a real estate agent. So real estate agents can help you and they're there to service. They'll help you identify a home that's right for you or an apartment or a condo or a townhome. They will help you present your offer. They'll help you negotiate a price by seeing what similar homes sold for. They'll help you find financing. They'll represent you at closing. Closing is where you sign all the documents and transfer ownership. It's worth noting that as a buyer, you aren't paying the real estate agent. The seller is the one who's paying the real estate agent. Typically, if I sell a house, $100,000, 5% of that, and I'm making up numbers here, 5% of that goes to the real estate agents. Half of that goes to my real estate agent who's selling the house, and half of it goes to the real estate agent who's working with the person who's buying the house. The seller generally is the one who is paying the cost. So if you're new to buying a home, working with an agent generally doesn't cost you anything. I will say that you can sometimes work on your own if you're comfortable doing that and say, I want that 2% as a discount. The other thing is that you should be really careful of dual agents. So let's pretend I was a real estate agent and I'm both acting as the seller's agent and as the buyer's agent so I can get double commission. If that's the case, it's really hard for that agent to try and figure out, well, should I lower the price? Should I raise the price? Who do I help? Who do I hurt? It's not recommended for people to use dual agents. There are exceptions. Let's say you found a home that you really want to buy. One of the things you're going to need to do is try and figure out how much you pay for that home. And there are lots of things that affect housing prices. The prices of houses in the area, the current demand for housing, the current supply, the market price, the owner's need to sell, financing options that are available to you, the interest rate. What I want you to know that's not on this list is no one cares how much the previous buyer paid for the house. So if I bought a house and I paid $100,000, but the market price is $300,000, it's irrelevant that I paid $100,000. If I paid $300,000, but the market price and all the homes in the neighborhood are selling for $100,000, it's pretty much irrelevant that I paid $300,000. What determines the market price or the home's value is what people are willing and able to pay for it, the market price. An agent will help you work through and negotiate a purchase price as well as making counter offers and contingencies. So a contingency is something like, I'll buy the house if mine sells, or I'll buy the house upon inspection and I have a professional come in and ensure that the house isn't going to break and that the roof looks good and that the foundation is fine. Those are like contingency clauses. There's something called property mortgage insurance, PMI. So if I'm going to buy a house, generally the bank wants me to put a certain amount down. Why do they want me to put some money as a down payment into it? Well, let's say I buy a house for $100,000 and I put no money down. If the house price falls to, say, $50,000, I'm going to be out $50,000. One thing I could do if I have no money into it is simply walk away from the house and lose my credit and say, okay, that's fine, and buy a new house for $50,000. Yes, it would hurt my credit, but I wouldn't be out the difference of going down. So they want you to have some skin in the game to make sure you're not going to walk away from the mortgage. If you have less than 20% down, you have to pay what's called a property mortgage insurance. This property mortgage insurance is normally $100 plus bucks a month or so, and it does not go towards paying off anything. It is just insurance that if you were to walk away, the insurance would help the bank cover some of their loss. Generally, you want to get rid of paying property mortgage insurance as quickly as you can. Once you hit, if you pay 20% down, you're good. Or when you hit 22% of equity, then it's automatically terminated. So we've talked about how risk and interest rates relate to each other before. So think about it. Why would there be less risk for a bank if you have a larger down payment? Well, we just talked about it. If you have a bunch of money in the house, you're not going to let it fall apart because you want to be able to get your money out. The more money you have in the house, the more you're going to care for the house and keep an upkeep, and less likely to simply walk away if home prices fluctuate. So if there's less risk for the bank, the more money that you have in, what's going to happen to the interest rate? Well, typically, as you add more money into the down payment, your interest rate will slightly decrease as well. So do you think there's more risk of inflation over the next 15 years or the next 30 years? Think about risk again. Any inflation that happens in the next 15 years would also happen in the next 30. But in the 30 year, you have year 16 to year 30. So you're obviously going to have a greater risk of inflation over a 30-year loan. So if you can pay it off shorter, if you can take a loan and pay off the house in 15 years rather than 30, well, there's less risk for the bank there too. So the shorter the loan, the lower the interest rate that you're going to be paying. Okay, so the next step is you have to obtain financing. A couple things. One is we're going to talk about things at a real high level here. In this class, we're going to do a project where you're going to build a spreadsheet in Excel, and we're going to play with some parameters. We're going to change the term from a 15-year to a 30-year. We're going to change the interest rate from 5% to 7%. We're going to change various odds and ends. You'll see how all these different parameters change and impact the cost of a house. For now, we're going to take a step back. A couple more things. I dug around everywhere because I just saw an article and I can't find it that said that there was a vast majority of people who buy houses go to one lender, say, well, what's the interest rate that you would charge me? And don't compete for other lenders. Don't go other places. And you'll see real quickly that, a 0.5%, 1% interest is a huge deal on a couple $100,000 purchase over 30 years. Another huge mistake is people aren't shopping around to find out what the best interest rate. We'll talk about what you can afford, what you can't afford. There's a guideline of 28 to 30%, 36% of gross income, although that's really general. So some people have other expenses. You may have college debt. You may have cars. You may have other outstanding credit card debt. other people don't. So that's why there's this range of what you can afford and what you can't afford. Well, we'll talk about prepaid interest, or what's called points. So instead of paying the going interest rate, you could prepay some of that interest and lower the interest if you want, which is generally a good idea if you're planning on living in that house for X number of years. If you're not planning on living there, there's no reason to prepay interest. So a mortgage is on a specific piece of property. You go, you ask for a loan on a certain address. They'll end up doing an appraisal to say, well, what do we think that house is worth? Can we lend you the money? Because if you don't pay it, can we get our money back? You can take out different terms. So you could say, I'll pay it back in 10 years, 15, 20, or 30. The most common by far are 15, 20, and 30, with absolutely the most common being the 30-year. They typically have a fixed interest rate, but not always. So you could say, all right, I agree to pay you back, and it's going to be at a 4% interest rate, and it doesn't matter if there's inflation or other stuff that occurs, that's the rate you're going to be paying it back. There are several phases here, right? You meet with a lender. The lender obtains your credit report and says, yes, you're good risk or not a good risk, and they'll either approve you or deny you. When they approve or deny you, you're typically what's called locked into an interest rate. So if I call today and the interest rate is 5%, if interest rates go up a quarter of a point or go down a quarter of a point, I'm locked in when I sign. So it gives me some protection to be able to plan what my mortgage will be. But just know that once you're locked in, you're locked in. You can't, even if interest rates go down, you've locked in at that interest rate. So this isn't going to be a surprise. What can make you qualify? Well, the more income you have, the more likely you can qualify. The less debt you have, the more likely you can qualify for a loan. Your credit history and your credit score, your ability to demonstrate to the bank that you've been lent money before and that you've paid it back is huge. The amount of down payment you make, that shows that there's some skin in the game, for lack of a better word. The length of the loan, the longer the loan, right, you're going to take out $200,000. If you have to pay it back in 20 years or 30 years, the longer the loan, the lower your mortgage is going to be, but the more interest you're going to be paying. And also the current interest rates, the current mortgage rates. The higher the interest rate, the more of your money that you can afford for housing is going towards interest, the less you can afford for a house. That's going to influence how much you can buy. We talked briefly about points. I'll show you what that means in a split second, but you can prepay and get a lower interest rate. So they may say, okay, well, I will cut the interest rate by a quarter percentage for a half a point, and we'll show you what that means. But you're prepaying the interest, and it's normally a good idea if you're going to be there for a long time. It's not a good idea if you're going to be there for a short time. Our book uses some tables. And so let's say, for example, you're going to do a 30-year loan at 7% interest on $223,000. There's a table that shows, based on the number of years and per $1,000, and it shows that at 7% interest on a 30-year mortgage, you would have to pay $6.65 for principal and interest. Well, you're not taking out $1,000, you're taking out 223 $1,000 loans. So your principal and interest payment would be $1,482.95. There's another term that they use, which is called PITI, which is the principal, interest, taxes, and insurance. So even though this is what you're paying the mortgage company, you also have to pay your taxes, which are substantial, and insurance, because when you take out a loan, the lender is going to require that you have insurance in case something happened to it, that they don't want your house to burn down and then they're out money. The insurance has to be covered while you have a mortgage. There are various ways to get this principal and interest. We're going to be using Excel to show it. There are formulas and financial calculators as well. If this interests you, there are all sorts of YouTube videos as to how to calculate this. But don't worry about it too much for this class. When you go and talk to someone about getting a loan, there are going to be all sorts of different topics. There are going to be what's called fixed rate or variable rate, adjustable rate. And what that means is, so if today the interest rate is 5%, I could lock in at 5% over the life of the loan. Or if I'm willing to let it fluctuate with what happens in the economy over time, I can get a lower rate because the bank isn't at risk, which you should be asking yourself, well, who's at risk? You're at risk. So if you're at 5% interest, if the interest rates go down, that's great for you. That hurts the bank. But it could only go down at most by 5%, right? But interest rates can go up, and they can go up substantially. So if they went up to 10%, 12%, 15%, you're going to be at risk. Typically, they have what's called, it will follow the prime interest rate and can adjust by maybe 1 or 2% each year with a max of, say, 5%. So that way there's some limit to it. The amount of down payment you make can vary. You can put whatever you want down. The more you put down, typically you'll get a lower interest rate on certain key milestones. Those milestones typically are 5, 10, or 20%. The term of your loan is typically 15, 20, or 30. There's some that are less. There are actually some that are more. They're harder to find. And all of these are called conventional loans. Then there are other loans like VA loans, which are specific to our vets who get better deals. So if you're a vet, make sure you check with the Veterans Administration before you get a mortgage. Often there are closing costs and lower interest rate. And there are some things called creative financing. So the housing had a big problem with this only a few years ago. There's something called an interest-only loan, which is where let's say I buy a $100,000 house at 5% interest. Well, then I have to pay $5,000 in interest to the bank every single year, and I'm not paying any principal. So when will I own that house? Never. I'm going to have those interest payments forever. They're only going towards interest. This was more common, and it allows you to buy a bigger house, but it's generally not recommended from a personal finance point of view. But just know there are interest-only loans, and that's what it is. So I thought it'd be useful to put some of the stuff that we're talking about in numbers. So let's pretend you're taking a loan for $250,000, which isn't a great number, but I looked at the Twin Cities market and the average price is about $240,000. So I said $250,000 and did all this, but you'd have to have some sort of down payment, but that's okay. So let's say you have good credit and you decide to take a 30-year loan at 5% interest. Your monthly payment would be about $1,342. That's your payment, so there's no taxes or insurance on that. Now, over the life of that 30 years, you would spend $233,000 in interest on a $250,000 loan. That's a lot of money. So now let's talk about using that as the baseline. Let's talk about a couple quick changes. Let's say you didn't have good credit. So let's say you're a college student right now. You're not paying your credit card bill all the time. You're using it for gas and other stuff. You need to be paying it on time. If you don't have good credit, maybe they charge you 2% more, which doesn't sound like much. But look at your monthly payment. Your monthly payment went up by over $300. Over the life of the loan, you would now spend $350,000 in interest on a $250,000 loan. That 2% interest rate costs you $115,000 over the course of that 30 years. Well, what about if you change the term of the loan? So instead of having the money and paying it back over 30 years, you're going to pay it back over 20 years. Notice what happens. From the first line to the second line, you're going to have to pay more money. Why? Because you're going to pay it back quicker. But a greater percentage of that money is going towards principal than interest. So the amount of interest that you pay is only, and I'm using that term loosely, you're only going to pay $145,000 in interest. Just from going from a 30-year to 20-year, you are going to save yourself almost $90,000 in interest payment, which is huge. Remember, when you go from 30-year to 20-year, there's less risk in it from the bank. And typically, they will also give you a lower interest rate. So maybe you're at a lower interest rate and you decide to go for a lower term. Maybe you decide to go for a 15-year term. If you do a 15-year term at a slightly lower interest rate, now, yes, your monthly payment went up, but now you're going to only pay $95,000 in interest, and you're going to save $130,000 in interest compared to your baseline. So really, the shorter that you can pay it off, the better you're going to be, and the lower the interest rate, the better you're going to be. So think about how you can identify and signal to the bank that you should get the low interest by getting good credit going now. Not paying your credit card bills now can cost you hundreds of dollars later. Work on that now. So let's say you decide to go with that $250,000 house, 30-year loan at 5%. Your property or principal and interest would be $1,342. So that does not include taxes or insurance. So your payment would be higher. In the first year, if you multiply this by 12, you would have spent $16,104 on your house payment. But a vast majority of that is actually going towards interest. So your interest is heavily weighted up front. Your principal is heavily paid off in back. This interest payment of $12,400 is a tax deduction. So depending on what tax bracket you're in is how much of it you'll get to write off your taxes. So let's pretend you're in the 25% tax bracket. Now remember, a deduction only gets applied at the percentage of your tax rate. This is not a tax credit. This is a tax deduction. You will get to deduct $3,100 from your taxes, which is about a $250 subsidy. It's like the government is helping you out there. So your real net payment is $13,000. $16,000 minus the $3,000 is $13,000. So your net costs of buying that home, even though you're paying $1,342, is only $1,083. Now again, doesn't include any upkeep or property taxes or insurance, but this is to show you how taxes can influence whether you should purchase something or not. It's worth noting that property interest is tax deductible. A lot of people, when they buy a home, will do something that's called a second mortgage or a home equity line of credit. So what does that mean? A couple things. So let's say a few years down the road, your house has a value of $200,000 and you owe $125,000 on it. That means you have $75,000 of equity. Well, think about it. You would not do this, but what if you sold it to yourself and bought it back? You would need to put 20% down payment, right? You'd have to have $40,000 to rebuy your house, which would mean that the bank would basically be able to lend $160,000. You already have $125,000 of that loan available. The bank is going to deduct what you owe off of what the maximum they're willing to lend, and they'll say, okay, yep, you have $75,000 of equity, but $40,000 of it is required to keep you at the 20%. So we'll lend up to 80% of the house value. Of the 75, you have to keep 40. We will lend you $35,000. Now, why would you possibly want to do that? Well, maybe you have a large repair, a roof repair, or something else. The other thing that you may want to consider is that on a home equity line of credit, this money that you borrow here counts as a deduction again because it is another mortgage. So if you wanted to use this to buy a car or some other property or something else, it's tax deductible. And typically it's going to be at a lower interest because why? Your house is your collateral. Now here's where it's a double-edged sword. You get a lower interest rate because your house is collateral, but now if you can't pay that back, you are going to lose your house because you're putting your house up as collateral. How do they determine this house value? They're going to determine based on that appraisal process, just like when you bought your house the first time. They're going to go out and say, well, how much is the home really worth? But anyway, that home equity line of credit is a common financial tool. There are some other types of financing that's out there that's in the book that's worth looking into. We're not going to cover much here because I don't think it's really relevant for this class. Reverse mortgages, refinancing mortgages, escalating payments. Reverse mortgages, if your parents or someone over 62, they could basically sell the home to the bank and then the bank will pay them and they're collecting a monthly income stream that's tax-free. Could be useful as you get older. Refinancing, we talked about it. When would you want to refinance? When wouldn't you? Well, if interest rates go down, you want to refinance. If it goes down enough to cover the cost, you're going to save a bunch of interest as we showed before. And escalating payments. So you'll see that there's all sorts of products out there that'll say, we'll help you pay down your interest faster or pay down your mortgage faster. Here's a trick. You can do that yourself and it's a good deal. You should do it. If you pay one extra payment a year on a 30-year loan, typically the 30-year loan can be paid off in 23 years. Now, you don't have to come up with the $1,300 or $1,400 on the previous example. If your monthly payment is $1,300 divided in 12, it's about $100 a month. Add on an extra $100 in principal every month, and you're going to pay that 30-year loan off in about 23 years. When we do the Excel worksheet, you'll see, well, when we put in an extra spot where you could add in extra principal, and you'll see how much that impacts the interest you're paying. It's really something that you should try and consider.